Welcome to the deep dive. Our mission today is pretty simple. We are giving you the ultimate shortcut to mastering your money mindset.
Yeah.
Forget reading a decade of financial research. We've done the hard work, consolidating all this brutal evidence-based investing wisdom from, you know, deep academic papers to vibrant community intelligence, and we've distilled it into the 20 most critical lessons.
Right.
The lessons you need to stop making behavioral mistakes and, well, start succeeding financially, like right now.
Investing is so deceptively accessible. It's so easy to sign up, easy to click buy, but it is profoundly difficult to master. And not because the core mechanics are complicated. They're actually really simple, but because human nature and these, massive institutional incentives of the financial industry are just constantly working against rational wealth-building behavior.
Totally.
So we're going to unpack those counterforces and give you actionable knowledge that separates the myth of complex strategies from the reality of simple, sustained wealth creation.
And before we get into it, if you are serious about building on this foundation, with more deep niche financial and tax planning content.
You must immediately subscribe to Money Mindset.
Absolutely. So our deep dive today is structured to tackle the biggest, most frustrating question in finance. If the simplest strategy, low-cost indexing, is mathematically proven to be the most effective for most people, why is it so often ignored?
Yeah, why do people go for the expensive, complex solutions?
Exactly. We're starting with a brutal reality check, moving into the hidden costs and traps, and then ending with the surprisingly solved truth of how to manage your money. And you'll want to stick around because we will reveal the ultimate counterintuitive truth. The best investment strategy for you might actually be the one that makes the least money on paper.
Okay, let's start with a foundational, slightly deflating truth. Lesson 1. You're not that smart relative to the market.
That is a brutal way to start, but it's so critical to internalize. This isn't a personal insult to your intelligence.
Not at all.
This is a cold, hard recognition that when you execute a trade, when you think you found some insight or a stock tip that the price doesn't reflect, you are stepping into a global arena.
Right. You're competing against the aggregate intelligence of the fiercest, most well-capitalized arena in human history.
Think about the scale of that. Your competition.
Yeah.
What are we talking about?
We're talking about trillions of dollars flowing daily, powered by the world's most sophisticated technology. Algorithms, high-frequency traders, vast research departments.
Sharpest minds available.
Exactly. People with satellite data and advanced machine learning models that are looking for advantages measured in, milliseconds. Every single day, maybe 100 million stock transactions happen worldwide.
Wow.
The price of that stock at that exact moment is a consensus wisdom of that massive aggregated intelligence.
It's the paradox of skill and action, right? The market has become so skilled and so efficient that the ability for any single person, even a full-time professional, to consistently beat it, that ability just decreases relentlessly.
Yeah, the cost of entry is near zero now. You can open a brokerage account on your phone in minutes.
But you don't see your competition.
No. You're not competing against your neighbor who also just opened an account. You're competing against the aggregate intelligence of every institution and professional trader on the planet.
So when you think you have an edge on a trade, what's the actionable thing to do?
You have to pause and ask 2 questions. First, why is the institution on the other side of that trade who has, 100 times your resources willing to sell to you right now?
Right.
And second, and maybe more importantly, what do they know that you don't? Just acknowledging the near-perfect efficiency of the market is the first step toward rational behavior.
Okay, so moving past the efficiency of the crowd, lesson 2 addresses the narrative that enables our worst behavior. This time is always different.
But the outcome isn't.
But the outcome isn't, right? We hear this during every crisis, every tech bubble, every housing spike.
It is the perennial behavioral killer. Market crashes and bubbles are not merely defined by the facts like the rapid rise or the sharp drop in asset prices. They are entirely defined by the narrative of uncertainty that comes with them.
So the story is what matters.
The story changes behavior. The facts about valuations might be stable, but the story, it's a new paradigm, or this sector is immune to recessions. That changes behavior. And when behavior changes, emotion dictates decisions.
We have a perfect historical case study for this, right? The Magellan Fund under Peter Lynch.
Oh, yeah. Lynch was objectively one of the greatest portfolio managers ever. He achieved a phenomenal 27% annualized return over his 13-year tenure.
Just crush the S&P 500.
Crushed it. Yet when academics analyzed the inflows and outflows, so the behavior of the average investor dollar, they found that the average dollar invested in the Magellan Fund actually lost money.
How is that even possible?
Performance chasing. It's that simple. The average investor was only drawn in by the exciting story and the incredible past returns after the fund had already peaked, and the narrative of success was loudest.
So they all piled in at the top.
Massive capital inflows rushed in late, only to be crushed by the next market correction. They bought high and sold low, often panic selling during the first significant dip because they were motivated by euphoria, not by discipline.
The narrative cost them everything. Which brings us to lesson 3. A truth that I think so many retail investors just fundamentally misunderstand. The market is forward-looking. It is a prediction machine.
This point is so crucial. If you are acting on news a company announcing strong quarterly results, a new government policy, whatever, that information, unless it is truly non-public, has already been incorporated into the asset price.
It's already in there.
It's already in there. The market doesn't price assets based on what's happening now. It prices them based on collective expectations about the future.
So the actionable takeaway here has to be really clear. When you're considering an investment decision based on some piece of information, you can't just ask, is this information valuable?
Right. You have to analyze how your prediction about the future differs from the market's existing prediction. If the market expects 15% growth next year, and you think the company will hit 15% growth, there's no trade to be made.
You have to bet against the consensus.
You have to predict 18% growth or 12%. You must bet against the consensus and be right.
I think we have to bring in Michael Mauboussin's point here. It's so powerful.
Yes. The single greatest error in the investment business is failing to distinguish a company's fundamentals, which you can know, from the expectations implied by the market price, which you have to figure out.
The market has already priced in the expected success. Your opportunity is only in the difference between that expectation and reality.
Exactly. And given that the market is a sophisticated prediction machine, lesson 4 naturally follows. Market forecasts are not useful.
Not at all. We see this every single year. Every major bank, every brokerage, every media outlet, they trot out their crystal ball predictions for the S&P 500 or oil prices.
And what happens?
They're wrong more often than they're right. Just look at 2023. The range of S&P 500 predictions from top Wall Street analysts was massive, and the actual result, which was driven by things nobody expected, it crushed even the highest, most optimistic forecasts.
The moment a surprise happens, the market adjusts instantly.
Right. So paying attention to these forecasts, and even worse, making tactical decisions based on them, is just detrimental to your investment process.
If the experts with unlimited resources can't get it right, why should you assume your ability to act on their flawed forecasts will lead to success? Markets are moved by surprises, not by what is already known and discussed.
And this inability to predict is exactly why we land on the bedrock of long-term investing success, which is lesson 5. Time in the market beats timing the market.
Yeah. The math of successful timing is just absurd when you look at it over a long time horizon.
I mean, if you're starting your savings journey in your 20s or 30s, we're planning for 60 years or more of capital accumulation.
So to successfully time the market, you have to be right not once, but twice. Getting out at the top and getting back in at the bottom.
And you have to go consistently.
Consistently.
Yeah.
Over 6 decades.
Yeah.
I mean, the mathematical probability of succeeding is basically nil.
And this is where the behavioral reality just smacks you in the face. It is so easy to fall victim to hindsight bias. When we look back at the crash in March 2020 or the bottom in 2008, people say, oh, I would have bought there.
Of course they do. But in the moment when the news is screaming about job losses and global shutdowns, when you're facing a possible 50% drop, emotion takes over.
The last thing you want to do is put your money in.
The last thing any rational human wants to do is deploy their scarce capital. Discipline, through a systematic strategy like dollar cost averaging, is the only way to capture those long-term returns. Trying to time the market is playing a game against yourself that you are rigged to lose.
Okay, let's shift focus now from our own behavioral mistakes to the structural realities of the financial industry, the hidden costs and conflicts that actively sabotage your returns.
Yeah.
We can start with lesson 6. Most funds do not beat the market.
This isn't just an opinion. It is a foundational, evidence-based truth proven consistently across decades. We always talk about the S&P SPIVA report, which tracks active fund managers versus their benchmark index.
And the numbers are just brutal.
The data consistently shows that over 10-year periods, roughly 90% of actively managed funds underperformed the index. 90%.
And the reality is actually worse than that 90% figure because of this crucial statistical trap known as survivorship bias.
Right. Tell us about that.
Well, if a fund performs poorly for several years, it doesn't just stick around forever with bad results. It gets closed down or merged with another fund or just liquidated.
In a place like Canada, we've seen estimates that around 40% of mutual funds just close down over a 10-year period. They vanish.
So when analysts run these performance reports, the poor performers have vanished from the historical data. The resulting data set only contains the survivors.
Which makes the performance of the overall fund industry look way better than it truly is.
And even for the funds that survive, past success just doesn't predict future success.
Not at all. Those outperforming funds were often just lucky or, exposed to specific market factors that then reverted to the mean.
It's a massive capital allocation problem. Investors keep chasing yesterday's winners, pouring billions into active funds that just had a good run, only to suffer when those same funds underperform.
And this leads us right to lesson 7, which explains why these bad products persist. Incentives matter. You must always understand the mechanism of payment for any information or product you get, because that payment mechanism incentivizes certain behaviors from the person selling it to you.
This is so visible in the Canadian financial service industry. For decades, the dominant model has been the commission-based mutual fund.
Right. And these funds pay what are called trailing commissions, often 1% or more of the fund's value every single year, directly to the advisor or the firm, regardless of performance.
Meanwhile, low-cost index funds, they often pay minimal to zero trailing commissions.
So this structure creates a strong built-in incentive for advisors to push high-fee, actively managed proprietary products, regardless of whether those products offer superior performance.
Their livelihood is directly tied to the product's fee structure.
Totally. If their compensation is tied to selling a product that pays a 1.3% trailer versus one that pays, say, 0.25, their incentive is probably going to be completely aligned with the higher-paying product. You're fighting against a massive, deeply embedded institutional conflict of interest.
And those trailing commissions are what, fund lesson 12? Fees and taxes matter. The evidence is just overwhelming here.
Yeah, lower fees are, ironically, one of the best statistical predictors of future fund performance.
It's the easiest thing to control, yet they cause this devastating long-term drag. But fees are only half the battle.
We also have tax drag to contend with. Active funds typically have much higher turnover. They're constantly buying and selling.
Which means they're constantly realizing capital gains.
Exactly.
Right.
And those gains must be paid immediately in non-registered accounts. This makes them significantly less tax efficient.
This is such a silent killer. The active fund's already disappointing pre-tax performance becomes way worse after taxes.
Right. A low-turnover, globally diversified ETF might realize capital gains only rarely, but an active fund can generate huge annual tax bills, even if the fund's overall pre-tax return is low.
And there's another massive behavioral trap in tax planning that a lot of Canadian investors fall into.
They laser focus on minimizing the tax rate.
Yes, like investing exclusively in Canadian dividend stocks because they get favorable tax treatment. But they ignore potential returns elsewhere.
So if focusing on a 30% dividend tax credit means you completely miss out on decades of phenomenal returns from the U.S. and global markets, you focused on the wrong thing. What you should care about is the total after-tax outcome, not just the tax rate on one asset class.
And the reason these fees and costs persist is often due to this stunning lack of transparency and financial literacy. The Ontario Securities Commission, the OSC, did a survey.
Oh yeah, this was wild.
Respondents answered only 36% of questions about investment costs correctly. People often think their advisor is free.
Because they pay the MER inside the fund. They never see the commission or trailer fee being extracted directly from their bank account. The money is just deducted before they ever see the returns.
And that illusion of free advice fuels lesson 13. Complexity and costs are positively related.
Investors are, for some reason, subconsciously drawn to complexity. They like products with special features, promises of high current income, or this air of exclusivity, like a supersized TFSA via permanent life insurance.
We should just label this clearly. It's often manufactured complexity.
Yes. It's intentionally designed to be confusing, to make people feel that they need an expensive expert to navigate it. The complexity itself is the justification for the high, often hidden fees.
So the actionable takeaway for you is simple. Adopt the rule of thumb that simple, low-cost, transparent solutions usually dominate complex, opaque, high-fee ones.
Always. Take that permanent insurance example. It's sold as this tax-free solution, but the costs of the insurance and the management fees embedded in the policy just erode returns massively over time.
But it sounds special.
It's sold with an air of exclusivity, suggesting you get access to something special. In reality, the complexity generally makes you, the end investor, significantly worse off.
And this brings us to a foundational truth that often gets lost in the chase for investment returns. Lesson 9.
Good portfolio management does not make up for bad financial planning.
Your investment portfolio is just the vehicle to achieve your long-term goals, if you don't have the foundational financial habits in place.
Like saving enough, living within your means, minimizing fees and taxes, proper insurance, estate planning.
Right. If you don't have that, you can't expect some lottery-like event, like picking the right stock to fix the problem.
It's all about the compounding reality.
Hmm.
I've seen clients who come to me in their late 50s and they've missed the first 25 years of consistent saving.
So to meet their retirement goals, the required return they need is just totally unrealistic.
Totally. Instead of needing a historical average return of 7%, they might need 15 or 20% annualized returns for the next decade. They're hoping to out-invest bad behavior, but compounding works relentlessly against you in that scenario.
You've got to fix the habits first. No investment strategy can save you from a lack of savings discipline.
Okay, let's pivot now to how we should rationally think about risk and expectations in the market, starting with one of the most counterintuitive insights.
This one really messes with people's intuition.
It does. Lesson 8. Expected economic growth and stock returns are not related.
This flies in the face of conventional wisdom. Every investor intuitively believes that if a country or a sector is expected to grow incredibly fast, the next big tech platform or a rapidly industrializing nation, the stock market returns will follow.
But since the market is forward-looking, like we said in Lesson 3, that expected growth is already priced into the assets. If it grows exactly as expected, the returns will be mediocre, at best.
So returns are not driven by the economic outcome itself.
No, they're driven entirely by the relationship between the market's expectations and the actual outcomes. You only see excess returns when the actual growth is unexpectedly better than the forecast.
And if it's worse, you get a negative surprise.
Exactly, even if the growth was still robust in absolute terms.
The quintessential example of this has to be China.
Oh, absolutely. Over the last 15 to 20 years, China's economic progress and GDP growth have been truly historic.
So if economic growth equaled stock returns, the Chinese equity market should have generated staggering results.
Instead, their stock returns have been absolutely terrible, significantly underperforming major developed markets.
And that happened because the expectations were just too high.
The things people expect to do well, and those expectations were huge for China, often carry overly optimistic expectations and valuations, which suppresses future returns. High expectations create low returns, and low expectations create the potential for higher returns.
It forces you to realize that being right about an economic trend is entirely different from being right about an investment.
And we move from expected returns to the necessary risk you must take to earn those returns. Lesson 10. Risk and expected returns are positively related.
This is Finance 101, but people constantly try to violate it.
They do. You must endure volatility. That is, risk to participate in higher expected returns. If you want the potential upside of stocks, you have to accept that their value will fluctuate wildly in the short term.
Unlike, say, short-term government bills.
Right, which are safe in nominal terms but offer much lower expected returns. You're being compensated for accepting that volatility.
But here is the critical warning. Higher risk does not guarantee higher returns.
Yes. You must distinguish between compensated risk and uncompensated risk. Compensated risk is taking on broad market exposure owning stocks globally. The market compensates you for that.
Uncompensated risk is what?
That's when you layer on specific company-level risks or speculative short-term bets. For example, buying a zero-day expiry call option on a single stock, that's the highest risk imaginable.
It might make you wealthy if you get lucky.
It might. But the expected outcome, based on fees and volatility, is closer to zero or even negative. You are not being compensated with a higher expected return just because you cranked up the risk level. You're merely gambling.
This complexity around risk brings us to Lesson 11, where we need to decipher some jargon. The risk-expected return trade-off has a term structure.
Okay, that sounds super technical. Term structure, risk. Let's break that
Okay,
down.
please.
The relationship between what you define as risk and what you expect as a return changes fundamentally depending on how long you plan to invest.
So for a short-term investor, someone buying a house in 2 years, volatility is the definition of risk. They need to protect their nominal account value.
Exactly. But for you, the long-term investor with a 30 to 60-year time horizon volatility is much less concerning. The historical returns of stocks tend to overcome those short-term swings.
So for the long-term investor, what's the bigger existential risk?
Inflation. Inflation is the hidden destroyer of purchasing power. The risk in assets typically considered safe in the short term, like government bills, is immense over a multi-decade timeline. They are most likely to lose purchasing power.
Because inflation tends to be persistent.
High inflation is often followed by more high inflation. Over 30 years, fixed income assets are riskier than stocks. If you think investing is risky, wait until you hear about what inflation does to your cash. It shifts the entire definition of safety.
So if volatility is necessary and inflation is the long-term killer, how do we mitigate the rest of the risks we face? Lesson 18 gives us the answer.
Diversification is the only free lunch in investing.
It's the only free lunch because it's almost magical in its effect.
You reduce company-specific risk without reducing your expected market return. If you own a single stock, you're exposed to market risk, which you're compensated for, and company-specific risk, which is uncompensated. Diversification eliminates the uncompensated risk.
And diversification is so crucial because of the skewness problem.
A concept not enough investors understand.
Most stocks underperform the market index over their lifespan. A huge percentage of listed stocks even have negative absolute returns.
So portfolio wealth creation is usually driven by a very, very small subset of massive winners. Your Amazon, your Apple, your Microsoft of any given decade.
And if you run a concentrated portfolio of only 30 to 50 stocks, you might technically be diversified.
But you drastically increase the probability of missing the few stocks that actually drive the market's entire long-term return. Studies have shown a tiny minority of stocks are responsible for the majority of total stock market returns.
So diversification ensures you capture those rare, high-impact winners while mitigating the drag from the thousands of stocks that fail or underperform.
And this discussion of broad market ownership leads us to Lesson 16, which is a great aha moment.
It really is.
There is no such thing as a passive investment.
When people talk about passive investing, they usually mean buying an S&P 500 ETF. But even the S&P 500 is actively managed.
Right. Its constituents are actively chosen, weighted, and rebalanced by a committee. Any decision you make that deviates from simply owning the total global market in its market cap proportion is an active decision.
So even choosing the S&P 500 over the global market is an active bet on the outperformance of U.S. large-cap stocks.
The true spirit of passive investing, or indexing, means commitment to low cost, low turnover, tax efficiency, and broad diversification.
And it's vital to recognize that not all index funds are truly indexing in spirit.
Yeah, buying a sector-specific ETF index, say, an industrials index, is an active, concentrated bet.
Conversely, there are explicitly active funds, like those from dimensional fund advisors, that might meet the criteria of low cost and tax efficiency better than some index products.
So the takeaway is, focus on the process and the characteristics of the fund, not just the label on the tin.
And this realization that all investing involves choice, it kind of frees us up from the agonizing search for perfection. Lesson 14.
There is no single optimal investment strategy.
It's so common, especially online, to see investors agonizing over finding the single, perfect, objectively best portfolio. They argue over which asset classes, which factor tilts, which geographical weighting is mathematically superior.
But perfection is impossible. What matters is a strategy that aligns with your specific objectives, your constraints, your beliefs, and your personal preferences.
So that debate over the perfect portfolio or that rigid, almost cult-like mentality around certain index fund blends, it's a massive distraction.
It is. Two people can have materially different portfolios that are both entirely optimal for their unique situations. Consistency trumps technical perfection.
That realization is immediately followed by Lesson 15, the behavioral key.
The best investment strategy for you is the one that you can stick with.
Stick-with-itness is the single most valuable trait in a successful investor. You need a strategy you can adhere to, especially during market downturns when every emotional fiber in your body is screaming at you to panic and sell.
If you cannot stick with a strategy during the bad times, you will never capture the long-term benefits.
Let's use the dividend investing example again. Objectively, a diversified dividend portfolio might be suboptimal.
It can be tax inefficient, may lack diversification compared to a total market index, sure.
However, if the psychological boost of receiving regular, predictable income motivates a person to save more and, crucially, prevents them from panic selling during a 20% correction.
That behavioral benefit can easily outweigh the tax inefficiency or the small drag in expected return.
But it has to be a reasonable strategy, of course.
Right? A diversified fund, not a high-risk bet on a single stock. But if that strategy is the motor that drives saving discipline, it wins. Behavioral returns are real returns.
And that framework of judging behavior leads us to Lesson 19, which gives us the yardstick for judging our own choices.
Investments should be evaluated on process, not outcome.
Outcomes are inherently noisy. I mean, you can make an absolutely brilliant, well-researched, diversified decision and just get unlucky for a year because of market noise.
And conversely, you can make a terrible decision, like betting the farm on a meme stock,
Right.
and get lucky for a week.
Right.
Statistical reality shows it takes a massive time horizon. Some academics suggest it could take 68 years to prove genuine stock-picking skill to filter out luck from skill.
So you have to consciously avoid that Kahneman System 1 thinking trap, equating a good outcome with a good decision.
Focus intensely on the quality of your decision-making process. Did you diversify? Did you control costs? Were you disciplined? That's all you can control.
So we've spent this time detailing the pitfalls, the behavioral traps, the counterintuitive truths. But when we put it all together, we arrive at Lesson 20, which should be empowering.
I think so. Investing has been solved.
For the vast majority of people, you are not going to fail to meet your financial goals because you didn't have access to some exotic product or a high-performing hedge fund.
No. The solution, investing in a broadly diversified portfolio of low-cost total market index funds, is the core, good enough approximate solution. It's universally accessible, incredibly cheap.
I mean, you can own the entire global stock market for a couple of basis points now.
And it's mathematically superior to almost all active alternatives.
Start there. Fix your savings habits, master your planning, manage your behavior. Only once all of those foundations are absolutely checked off, maybe then look to deviate.
But approach those deviations with extreme skepticism, knowing that complexity is usually a sign of high fees, not high returns.
And that skepticism is totally warranted, according to Lesson 17.
Wealth does not give you access to market-beating investments.
This lesson directly confronts that false narrative of exclusivity often peddled by the financial industry. They suggest that once you reach a certain level of wealth, you get access to superior products.
Hedge funds, private equity, complex permanent life insurance.
Right. And Warren Buffett himself has talked about this. How these high-cost, exclusive products are often access funds, where the high complexity and the high cost are what fundamentally erode the returns, not enhance them.
Yeah, and the current marketing trend pushing this narrative is pension-style investment management. It suggests that you, the individual investor, need access to the same exotic assets as a large pension fund.
But your personal financial goals are entirely different from those of a massive, perpetual institution.
This complexity is often just manufactured to justify high fees and the illusion of exclusivity.
Which leads us naturally to the systemic conflicts we see across the industry, particularly in the mass market retail environment. This was highlighted recently by the intense CBC scrutiny on Canadian banks' financial advice practices.
This is so crucial for you, the young investor, to understand.
The issue is fundamentally rooted in the fact that the primary place the average person gets financial advice walking into their local bank branch is dominated by a sales culture, not a customer service environment.
These institutions are publicly traded, profit-driven companies. The priority is moving proprietary product.
And academic research clearly supports this systemic conflict. There was a detailed 2018 Swiss academic paper that provided a stark illustration.
It showed that bank advisors overwhelmingly tended to recommend the bank's own mutual funds and structured products, the exact products most profitable for the bank, which usually carried higher fees.
The study found that advised trades resulted in higher profits for the bank, but demonstrably worse performance for the client.
It's a deep structural conflict. The bank advisor is primarily prioritizing their employer's interest, not their customers, because they are being paid to sell the proprietary products.
And the specific quotes that surfaced in the CBC reporting were shocking because they removed any doubt about the internal culture. We saw internal communications from employees describing aggressive sales environments. One employee described being pressured to mislead customers into getting products they didn't need just to meet crushing sales targets.
And another stated, and this is a direct quote, "It's not a customer service environment. We're there to sell and make money for the bank."
Now, we have to nuance this, of course.
Sure, there are excellent fee-based fiduciary advisors who work in the higher-end brokerage divisions of these banks, but the average person walking into the branch will never meet them.
They are subjected to branch-level tactics driven by this internal sales pressure.
And it's also true that many individual advisors are driven by what we call myth-guided beliefs, genuinely thinking they're doing the right thing because they make the same mistakes in their own portfolios.
Right, but regardless of intent, the outcome for the customer is the same.
High costs, poor performance, and complex products they don't need. This entire section serves as a massive warning. Be skeptical of any advice that seems to lead exclusively to high-fee proprietary products.
We've covered 20 lessons, moving from the brutal, efficient reality of market competition to the solved simplicity of low-cost indexing. Now, for our personal deep dives, 2 actionable insights outside of finance that focus on applying discipline to overcome behavioral inertia.
Mm-hmm.
I want to start with my unexpected motivation hack: virtual reality exercise.
I'm still intrigued by this. You mentioned a boxing game as a replacement for traditional cardio.
Yes, the game is called Thrill of the Fight, and it's a total game changer for anyone who struggles with fitness motivation. Here's the problem with traditional exercise, like a stationary bike.
Okay.
When you get tired, the voice in your head immediately gives you permission to quit because there's no immediate consequence.
Right.
But in VR, the gamification element is pure psychological genius. When you have a reachable opponent coming at you, actively trying to knock you out, the incentive to keep throwing haymakers, to duck, to weave, and to keep going, even when you're completely gassed, overcomes that psychological barrier to quitting.
So the competitive element overrides the pain response.
Precisely. After 15 minutes of nonstop action, you're drenched in sweat and absolutely done, having completed an intense physical workout, but you didn't quit mid-session. The immediate goal was beating the opponent, not just counting calories.
That's an actionable tip for anyone who finds the psychological barrier to intense exercise too high.
Totally.
That is applying external structure to overcome internal motivation failure, which is a great parallel to finance. My personal deep dive is on the complete opposite side of the health spectrum: fixing sleep, using a technique I recently started.
Okay.
It's called cognitive behavioral therapy for insomnia, specifically sleep restriction.
That sounds punishing, like you're deliberately depriving yourself of sleep.
It is, initially, and it requires immense discipline, which is why it works.
Yeah.
The goal is counterintuitive.
Yeah.
You compress your sleep window to force your body to reset its circadian rhythm and improve sleep efficiency.
So if you typically go to bed at 11 and toss and turn till 1, but wake up at 7, your efficiency is low.
Exactly. In sleep restriction, you deliberately go to bed later, say 11:30, even if you are tired, but you must still wake up at your target time, like 6:30.
So you drastically reduce the time spent lying awake trying to fall asleep.
Exactly. This forces your body, which is increasingly tired, to utilize that shorter window entirely for sleep, resulting in much better quality. Then, once your sleep efficiency improves, you slowly extend the window by going to bed 15 minutes earlier.
It's a classic example of forcing a disciplined, painful process to fix a long-term behavioral outcome.
Just like discipline settings, it's evidence-based, and my sleep has dramatically improved in quality.
Which perfectly cycles back to our final provocative thought. We've established that investing at its core has been solved by low-cost indexing. It offers the best statistical path to wealth for most people. Yet the market is still absolutely flooded with complexity, high-fee products, and institutional pressure to sell those products. So if the core knowledge, the 20 lessons we just covered, is so remarkably simple and so effective, why is it so incredibly hard to deliver it to the people who need it most?
You mean particularly young adults and novice investors who don't meet the high minimums required by fiduciary fee-based advisors?
Exactly.
That problem is the exact structural failure we're committed to solving. It's why we're currently working to Canadianize Dan Solin's excellent book, Wealthier, designed specifically to teach millennials and younger generations how to DIY their initial financial planning.
It is a direct response to the industry's failure to provide affordable, transparent, and simple advice to those just starting out.
It is.
Take these 20 lessons to heart. Stop agonizing over finding the perfect, complex strategy. Fix your foundational habits, master your behavior, and take control of the basics. We hope this deep dive helps you move from confusion to conviction.